Most investors are bleeding money from their portfolios from mistakes they don't even realize they're making. The 5 errors that we're going to go through today are quietly sabotaging portfolios every single day. And unless you fix them, no strategy will work long term, ever. Now, the top 5% of investors, we've totally eliminated these errors from our mistake and our processes. Today, I'm going to show you how to do exactly the same. And in mistake number 3, I'll walk you through the exact method I developed that completely flipped our results from inconsistent to consistent, and now achieving a solid 30% a year that had our hedge fund approved in Luxembourg in 2023. Now, the stuff we're going to cover in this video is stuff that I wish I had known very much earlier in my career. And I think you're going to feel exactly the same by the end of this video. So let's dive straight in. Okay, so mistake number 1. Let's start with something that I see time and time again and forms the bedrock of any portfolio. And that's bad stock picking. Now, after more than a decade of mentoring investors, I've had the chance to look inside countless portfolios. Some actually quite well constructed, others really a complete disaster. A common theme that I see across the board is really a lack of a structured process to picking top stocks. There's just a lot of guesswork and hope and hype involved. Ultimately, people end up buying what's popular, what looks shiny, but very little on the actual setup of the stock, how the stock is actually performing and how it's setting up to potentially move forward. That's really the bedrock of what makes a good stock. Now, in the portfolios that I've reviewed, I've seen capital tied up in only a handful of stocks. Sometimes that's just one stock, other times maybe 2, 3, 4 stocks. With a portfolio constructed like that, within a few months, that portfolio can be down 40%, 50%, which is horrendous. I mean, it's partly due to recklessness, but I believe that people generally start with the right intention. However, the system that they choose to use, or rather the lack of a system, doesn't often match the intentions. And before they know it, their portfolio is deep in the red. Now, you'll see how this ties directly into a timing strategy when entering a stock, which we will cover in mistake number 3. Because even if you pick the best stocks, if you don't have the timing correct, you will always tend to be on the wrong side of the market. So the solution, first of all, for mistake number 1 is actually very straightforward. To fix the issue of picking bad stocks, well, leverage technology. Move away from opinions and hype that we see plastered all over social media, and instead use technology, specifically scanners and charts, to create a system that removes the guesswork, that removes the chaos, and brings a more streamlined and linear approach to picking good stocks. Now, there are thousands of stocks available across 11 major sectors. So to manually go through each stock individually, well, it's an impossible task. It's not something that I would even have any inclination to do. Now, what a good scanner does when programmed correctly is that it will filter through 20,000 stocks and narrow down to the handful of stocks that are performing right now, not based on our opinion or based on our hope, but stocks that are actually performing based on market structure. Now, that's what makes a good stock. Now, here's something I want you to remember. One of the first rules of investing is to ignore opinions, including your own. Opinions have a very long history of getting people on the wrong side of the market. What I like about scanners and charts is that they actually help you remove opinions and focus on what the market is actually doing. They cut through the noise and focus on the actual performance of stocks. Now, the best performing stocks aren't the ones that get plastered all over our social media channels. This is something that I learned quite early on. True wealth is made from stocks that fly under the radar. They get absolutely no media attention. Our job as investors is to know how to find them using a structured approach. And guys, hype and opinion, that isn't part of it. If this is resonating with you so far and you want a visual version of everything we're talking about, including the process I use from start to finish, then grab the Stock Market Blueprint in the description below. It'll give you a step-by-step reference you can keep coming back to. Now, once you picked a good stock, often people then fall into the second trap, which is poor risk management. This is one of the fastest way to blow an account, especially if you're using leverage. Now, what tends to happen is this: when people find a stock, which often isn't one based on any real analysis, they then go all in. Too much capital tied up in a single stock. And what happens here is that emotion then takes over. You're emotionally invested in that stock. I've seen investors get emotionally attached to just the one stock and ride it all the way down simply because of the fact they've risked too much, ultimately convincing themselves that it's going to bounce back. Now, I've been there myself and I learned the hard way. Risk management is an essential component when it comes to the backbone of your approach. So what's the smart fix to issue number 2? Well, the answer is actually very, very straightforward. Manage your risk from the very beginning. Now, first of all, we've stacked the odds in our favor by picking high probability stocks, one with a statistical edge. However, we're still playing on probabilities. So the next step is to cap your exposure to 1 or 2% risk per stock. So instead of betting big, say 20% on one so-called hot stock, spread the risk across multiple high probability stocks. 1% on 20 stocks, not 20% on one stock. That way, no single loss can take you down and you're not emotionally invested in any single asset in your portfolio. And in mistake number 4, I'll show you how to protect those positions from being wiped out by random volatility while still staying in the trend. Ultimately, if a stock is winning, you want to hold on to it. Now, at this point, investors think they've done enough. They give themselves a nice little pat on the back, picked a good stock, sized sensibly, but then the next mistake is the one that quietly can undo all of that good work. And it's one that I personally struggled a fair bit with early on, but the fix, again, was actually very, very straightforward. Annoyingly straightforward, as if, why didn't I actually know that answer in the first place? But here's the thing, until you actually become aware of these solutions, you don't know. And there's no harm in not knowing. It's ultimately not fixing it, which is where the problem lies. So mistake number 3 is all about poorly timed entries. A big part of that is down to FOMO, the fear of missing out. Maybe there's a rumor or some buzz on social media and you know you've got to get a piece of the action. You see the stock flying and ultimately you rush in. The problem, again, is you're reacting emotionally, and that almost always leads to losses. It may work out here and there, but over the long term, it's just not an approach. Without a reliable timing method, you're just guessing. Again, you're reactive instead of strategic. As an investor, everything you do must be strategic. It has to be ordered. So I created a system to fix this, which I call the 4-phase sequence method, or the 4PS method for short. I built this method after really nearly giving up and walking away from investing altogether because it just wasn't working for me. But once you hear how phase 4 works, you'll understand why it completely turned my own personal performance around and how that eventually led to our hedge fund being incorporated in Luxembourg. It's a big part of it. Now, phase 1, look for stocks with a strong performance history. Stocks that have performed well in the past, big past gains, often indicate strong future potential. Microsoft, for example, it surged over 600% between 2016 and 2021. Now, when it comes to stock performance, that's the kind of stock you want to be looking out for. Okay, so phase 2 is consolidation, a long sideways market, often a period that people sort of get intimidated by. Here's a different way of looking at it. Think of a consolidation like the roots of a tree. The thicker and longer the roots, the taller and stronger the tree will grow. It's the same with consolidation periods. It's acting as a base for the next big leg up. Let's look at Deere & Co, for example. It went through a 30-month consolidation, then surged 130% from 2020 to 2021. And it's now actually repeating that process. It's broken out from another 3-year base. And so what we're expecting is another big move up. And if it's moved 130% in the past, in the last big rally, then that's an indication of what the future holds. It could potentially be a very profitable stock. But here's the thing. While we've been waiting for Deere & Co to set up and we've given it the time and space to move through that 3-year period of consolidation, our scanner has been busy working in the background, picking up all these other wonderful opportunities that had already broken out from a period of consolidation and been extremely profitable over the last 2 to 3 years. These are all skills and part of the process of an accomplished investor. Don't get just narrowed down into one stock and wait for it to move. There's a plethora of stocks out there. Find them, have them in your portfolio, and then rebalance. Now, phase 3 is the breakout. This is when the stock first starts moving out of its base. This is the sign that the next uptrend is about to begin. But where patience is very much needed, because what can happen in phase 3 is a fake out. And a fake out is when a stock looks as if it's going to move and start on its next big uptrend, but in fact reverses and moves back into phase 2, and when you can be ultimately stuck in a sideways market for a prolonged period of time. Give the stock some time to mature. When it moves from phase 2 to phase 3, allow it the time to confirm that the next uptrend has started. Allow it to move a couple of more breakouts before you actually jump in. And that is where phase 4 comes in. I said early on that you want to understand where phase 4 comes in. Phase 4 is actually the start of the confirmation of the next uptrend. And this is when we jump in. This is our signal to enter. This is where you catch the meat of the move all the way up. And it's not based on hype. It's not based on guesswork. It's based on a strategic approach, a sweet spot between looking at market structure and good timing. And here's a pro tip for you. Do not stop there. The best investors don't just sit on a winner. They do something that very few people do, and that is they compound. That is how real wealth is built. How do you compound? Well, that's adding more of a winning stock into your portfolio. Every 2%, 4%, 6% above your original entry, that is an opportunity to start adding more into your portfolio. Let those gains stack. And here's the thing, by eliminating risk on your previous position, you're actually adding more into your portfolio without adding more risk into your portfolio. But here's another pro tip. Only add to winning positions, never losing positions. Adding to losing positions is a way of blowing your account very, very quickly. Okay, now even if you picked the right stock and timed it well, this is where mistake number 4 comes in. Bad stop loss placement, which can ruin the trade almost instantly. No stop loss, massive risk, not something that I suggest you do. However, a stop loss that's too tight and you will get shaken out, something you're probably already experiencing and over. What tends to happen is that once you buy a stock, you think the danger's over because you picked a solid stock based on some analysis, you've allocated some risk, but when it comes to stop loss placement, it's always too tight. And what happens is that it turns a potentially winning stock into a frustrating churn of entries and exits where you completely miss the trend. So the fix for this problem, use the average true range, or ATR. What that tells us is how much a stock typically moves. And then here's the clever part. Use a multiplier to give the stock time and space that it needs to move. Because here's the thing, guys, a trend is a function of time. If you eliminate time, you eliminate the trend. And if you eliminate the trend, well, you eliminate profit. So let's look at ATR as a solution in a little bit more detail. Let's say Microsoft has an ATR of $7. If you multiply that by 4, you have a $28 stop loss. However, let's say Nvidia may have an ATR of $31. If you times that by 4, you have a $124 stop loss. You can see how using ATR becomes very useful because it gives you a stop loss that is unique to the volatility of the asset that you're looking to add into your portfolio. And this will stop you from being whipsawed out of positions by having stop losses that are simply too tight. It keeps you in longer when the trend is healthy and moving in our favor, but you also have a smart place to exit when the stock turns and fails. Now, here's another little pro tip for you. Turn that initial stop loss into a trailing stop loss as the position moves in your favor. By doing this, you're locking in small bits of profit and strategically compounding as the stock continues up. Okay, now before we get into mistake number 5, I want to say this. Learning a system like this is powerful, but it's even more effective when you're surrounded by others doing the same. That's why we built a community around this process. It's a place where investors share insights, stay accountable, and ultimately where we grow together. You'll find the link in the description below. We'd love you in there. Because the next mistake is the real test of whether your strategy works over time or basically is just a one-hit wonder. Mistake 5 is rushing the process, wanting instant gratification, because ultimately that's the world we live in, the social media world where we wanted everything yesterday. Patience is one of those really overlooked skills in investing, but it's an extremely profitable one. Rushing the process, well, that's just a recipe for sabotage, and it's precisely why people fail. Even a great setup takes time. A stock will often pull back before it pushes in your favor. A good trend will need months to fully develop and mature. The solution, again, very simple. Align with the market and trust the system. You use the 4PS method I went through to find quality setups and to enter at the start of phase 4, and then give the stock time they need to mature. But remember, you've got your stops in place as well and your risk management in place to protect you, but you still need to let the trend unfold. Now, here's the key advantage to giving a stock time to mature, and that is the compounding process, where we can accelerate the profit phase. By accelerating the profit phase, we recover the time typically required for a stock to reach its potential. But here's the remarkable part, and the one that you miss. Once you witness your money compounding and see the numbers grow exponentially, it all clicks into place. You'll never ever want to invest in any other way. Why would you want to do more to make less? With compounding, you're doing far less to make a lot more. So it may seem slow at first, but the compound effect more than makes up for lost time. Here's another pro tip. The daily 20 simple moving average and 50 simple moving averages are proven support zones. Stocks often pull back to these levels, bounce, and continue higher. And we use these to ride the trend and stay in winning positions as long as the structure holds. And they're also key levels where you can potentially look to compound your winning positions. You don't need to watch the screen all day. You need to give your strategy space to work. That's how the top 5% create exponential growth, while everyone else spins their wheels. The market doesn't reward guesswork. It rewards a structured process. It rewards consistency. It rewards resilience, and it rewards patience. Every solution I shared today, from stock selection to timing to risk management and compounding, only works when it's part of a clear, repeatable strategy. That's how us top 5% investors have won consistently, and that's how you can do precisely the same. Now, to make it all work together, you need to watch the next video and everything you need to profit from stocks. It gives you our full system, step by step, so you can put all 5 of these solutions into action, put those mistakes to bed, and start building the portfolio you actually deserve.